This is Matthew Cratter from Trader University, and today I want to talk about Bitcoin's flash crash and the IMF. No sooner had I published yesterday's video about El Salvador finally making Bitcoin legal tender than we began to see a very sharp sell-off in Bitcoin and the other cryptocurrencies, which are really copycats and follow along with Bitcoin. It was actually an incredible day if you think about it, because if we look at daily bars here and some Bollinger Bands, this is one of the few times I remember where Bitcoin touched both the top band and the bottom band in a single day. The length of the candlestick was about $10,000. And this is especially interesting to note when you consider that when I first started making YouTube videos about Bitcoin, Bitcoin itself was trading under $10,000. So we had a candlestick today that was actually, or a candlestick yesterday that was actually larger than the total price of Bitcoin when I first started covering it on this channel. So what caused this sort of volatility? There's been a lot of speculation that this was an attack by the IMF or something like that. I think at the most basic level, it was another case of buy the rumor, sell the news. So when we first heard about that El Salvador was going to move to a Bitcoin standard, I published a video on June 6th. This was when we can see what the price of Bitcoin was then. It was approximately, call it $36,000. So that was a very good buy point. And now, or yesterday when El Salvador finally moved to the Bitcoin standard and made it official, it's a classic case of the news has been confirmed and people sell into it. In addition to that, I think what we really were seeing was a liquidation among leveraged traders. A lot of traders had gotten themselves very leveraged long going into this. There are exchanges that offer up to 100x leverage, and I want to show you how this works, to show you how crazy this is, and to show you how cascading liquidations can lead to very strong price moves in Bitcoin. So as we said, many exchanges offer leverage, and the way leverage works, whether it's through futures or some other structure, is you put up a small amount of money in order to control a much larger amount of money. It's very similar to a down payment on a house, where you maybe put down 10 or 20%, you borrow the rest, and you control the whole price of the house, the whole value of the house, but your equity is just a small stub. So the way this would work in a crypto account at one of these exchanges, maybe you put up $1,000, you can leverage this 100x, which means they make you deposit $1,000, and then that gives you the power to control $100,000 worth of assets in your account. So you can put up $1,000 and buy $100,000 worth of Bitcoin. Now this sounds great, it works really well on the upside, but the real problem with this is it's extremely dangerous to combine highly leveraged positions with an asset that's extremely volatile like Bitcoin or one of the other cryptocurrencies. So let's say that you do end up controlling $100,000 worth of Bitcoin. The price of Bitcoin goes down 1%, which for Bitcoin that can happen in a millisecond. This is not a very big move. But if you're controlling $100,000 worth of an asset, it goes down 1%, you have a mark-to-market loss or a loss of $1,000. Now the problem with this, when you have 100x leverage, is that this ends up completely wiping out your account. You lose $1,000, but $1,000 was all you had in equity, in other words, in cash in your account. So what the exchange does is they now liquidate your position, and you might get a margin call really quickly, which means you need to add more capital, more cash to your account. If you don't add it quickly, you are automatically liquidated. Now you have $0 in your account, and you are no longer long Bitcoin, but the exchange forced you to exit your Bitcoin position. Now, if this happens, let's say you have multiple accounts or multiple positions, you begin to panic and you begin to sell off your other assets, or at least lighten up. So you sell off your Ethereum, your Cardano, your XRP. If you really don't know what you're doing, you own XRP. And what this does is this makes all the other cryptocurrencies sell off as well. You can imagine small retail investors doing this, or larger leverage hedge funds doing this. And this is why we see these correlated moves in cryptocurrency markets. When one crypto goes down a lot, it can lead, especially if it's Bitcoin, which is really the elephant in the room, it can lead to liquidations in other cryptocurrencies, and you end up with what we call cascading liquidations. Whereas the price moves lower, more and more people, especially leveraged traders, get stopped out of their positions. Now, this isn't a problem, of course, if you're just holding Bitcoin in a hardware wallet, you're not using any leverage. The most you can lose is if Bitcoin goes down to zero, which is highly unlikely. But there's no forced liquidation if you're not using margin. Now, in any market, whether it's crypto or a traditional market, if everyone is highly leveraged long, it's very easy for the market to crash. It's like everyone's on one side of the ship and then they run over to the other side of the ship. If everyone is leveraged short, in other words, betting on market declines, it's very easy for the market to melt up quickly, as we saw with GameStop, for example. Meanwhile, if you are not playing the leverage game, and I highly recommend and suggest that with Bitcoin being so volatile, you don't use leverage with it. While leverage traders are trying to get rich quick and then getting liquidated, meanwhile, the hodlers are very peaceful and are trying, in fact, to buy more Bitcoin, which we're going to try to do today since we weren't able to do it yesterday on the camera. Now, what happened yesterday? How do we know this was forced liquidations of leveraged positions? Well, Glassnode, for example, provides very good data on this. They wrote in a tweet yesterday that over $4 billion worth of Bitcoin open interest has been cleared during this sell-off. This is just a measurement of how many leveraged or futures positions are open, sort of the notional value of it. This is the most significant leveraged flush out since the sell-off in mid-May. And they have a nice chart here showing open interest and the decline in open interest in Bitcoin. If you're finding this video helpful so far, be sure to hit that subscribe and like button. Also share the video with a few friends. Now we can see this for ourselves. I like to look at bybit.com where they have liquidation data. Over the last 24 hours, we can see that there's been $3.44 billion worth of liquidations across all cryptocurrencies. You can toggle between these various menu items here, and you can see how much was Bitcoin. So 1.38 billion was in Bitcoin. It's slightly more because it's been a little bit more than 24 hours since that sell-off. We can go down here and take a look at the daily bar here, and this shows us the liquidations on the long side and the short side. The longs are the green numbers. We can see, for example, Bybit here had the largest with $1.19 billion worth of liquidations. The shorts were liquidated as well as Bitcoin moved around, but not nearly as large as the liquidations that happened on the long side. So basically leveraged long players getting forced out. The biggest liquidations, it looks like they happened on Bybit, Huobi, Binance, and BitMEX were really the big ones. We can also look at the decline in futures open interest or in perpetuals open interest. At the top here is actually not a bad place to see it across all the cryptocurrencies. Open interest down almost 27%, 26.8%. And this really shows just a contraction in the number of open derivatives contracts. Then we can see the futures open interest shrinking across all the different exchanges, which are listed here. We can see the 24-hour change in liquidation. So these are futures contracts. When you enter a new futures contract, it increases the open interest. When you exit a futures contract, whether it's selling or buying to cover, it decreases the futures open interest. If you want to learn about this, I talk a lot more about open interest in futures in my courses, which you can find at trader.university. But either way, we can see here that the open interest has been contracting across all of these exchanges, and these are mostly leveraged long positions, as we saw here. So we know that this was mainly driven on the derivatives side of things. So what about the speculation that the IMF was involved in this? We do know that the IMF has a motive. They don't like Bitcoin. They don't like anything that disrupts the current system where they can enslave developing nations with loans. And so they haven't been happy about El Salvador. They've made repeated warnings starting on June 10th, where they pretend this is really a lot of concern trolling, really nothing more than that. The IMF does not really care about the people of these countries. They just want to maintain their power. So we had warnings from the IMF on June 10th. Sherlock Holmes, obviously, it looks like the IMF has a motive here to do something. And the other thing, the president of El Salvador, Nayib Bukele, I'm not sure if I'm pronouncing his name correctly, he attributes the dip to the IMF, and he's sort of trolling the IMF in this tweet yesterday saying, thanks IMF, we bought the dip. Now, we don't know what he knows. We don't know how much of this is true or whether he's just accusing the IMF of causing this sell-off. Either way, it was fairly interesting, and I don't think I've ever seen a world leader troll the IMF and buy more Bitcoin at the same time. This is really, we live in very, very surreal times. Meanwhile, if we go back, we can see that the IMF kept warning about Bitcoin. They did it again on July 26th. There are a number of tweets here. Here's one from August 28th talking about the substantial risks. This is very ironic, especially given how fragile the current global financial system is, largely due to big alphabet soup letter agencies, institutions like the IMF. Another warning just a couple days ago about IMF reiterating its concerns over a country moving to Bitcoin. If you're on a Bitcoin economy, if you own Bitcoin, there's nothing that the central banks or the IMF can do to stop you. So you could imagine that they don't want people leaving the reservation. But this is really, I would say, nothing more than concern trolling. Now, either way, whether in fact the sell-off was due just to the IMF maybe giving a little push to the markets, it's hard to know whether there was an intervention or not. Either way, the markets were ripe for a correction, being highly leveraged to the long side, combined with this classic market dynamic of buy the rumor and sell the news. Either way, Bitcoin doesn't care. If it was, in fact, the IMF that was trying to make Bitcoin and El Salvador look bad on September 7th, they succeeded. The price of Bitcoin went down. But what does this really mean? It means that hodlers get to accumulate more Bitcoin at lower prices. Bitcoin moves from weak hands, from weak leveraged hands that are levered 100 to 1 or 50 to 1, and moves to strong hands like you and me who buy Bitcoin, put it away in a hardware wallet for the next 100 years. What happens when Bitcoin moves from weak hands to strong hands? Well, the Bitcoin supply shortage gets even worse. I will never sell my Bitcoin in my lifetime, and I hope my kids and grandkids, when I have them, will never sell it either. So what this does is whenever the price goes down like this and hodlers get to accumulate more, it sets us up for an increased Bitcoin supply shortage. Bitcoin is already extremely scarce, just 21 million. Many coins have been lost. Many coins are locked up in diamond hands. And so what happens when you have a Bitcoin supply shortage? Well, this eventually leads to much, much higher prices. And this is one reason, of course, that President of El Salvador said, thanks for the dip, IMF. It's interesting as well because the IMF just came out on their blog saying that Bitcoin is very volatile, obviously stating the obvious. Bitcoin crashed from 65,000 in April down to half that value 2 months later. And yet even the IMF realizes, they have this great phrase, and yet Bitcoin lives on. And this is one thing I think that the world central banks and the IMF and the WEF and all these organizations are very concerned about Bitcoin because they realize the cat is out of the bag. There's nothing they can do to stop it. They can give Bitcoin a lot of bad headlines. They can exacerbate the volatility that's already present in Bitcoin, but there is no way to stop it. Another news item that came out this morning that may have been anticipated by yesterday's move, it may not just have been El Salvador and the IMF. Brian Armstrong, who's the CEO of Coinbase, came out and said basically the SEC has been threatening them that if they issue a product where they allow you to earn interest on your USDC, which is a stablecoin, a US dollar stablecoin, that they will get sued by the SEC. And so this is significant news, not just in terms of the SEC strategy, in terms of trying to go after various cryptocurrencies. It's unclear whether Bitcoin is in their sights as well. Gensler said Bitcoin is sort of its own thing. Either way, this is potentially very, very bad news, especially for proof of stake protocols, anything where you're staking coins and earning interest. This could be quite bad, especially for Ethereum, which is doing a really dumb thing by moving from proof of work to proof of stake. So this sort of news, and especially if people knew about it beforehand and traded on it, this could have been another driver behind yesterday's volatility. So we'll see how the regulatory action plays out. Meanwhile, it doesn't really matter for Bitcoin. Bitcoin cannot be stopped. As the IMF said, Bitcoin lives on. Bitcoin is the honey badger of money. There's nothing you can do to stop it. You can try to stoke more volatility. You can try to drive the price down, which just makes it easier for people like you and me to accumulate even more Bitcoin. And Bitcoin really is the hardest form of money ever created, and it benefits from this volatility. It's the ultimate anti-fragile asset, as Nassim Taleb would call it if he still was a fan of Bitcoin, which he's not. But Bitcoin is highly anti-fragile. It benefits from attacks. It actually gets stronger from attacks. And when you compare this to other rivals like Ethereum, it's very, very easy to pull the plug on Ethereum. It's highly dependent on services like Amazon Web Services, AWS, and Infura, etc. Bitcoin is very different. And if the SEC does in fact go after proof of stake coins, there are a ton of cryptocurrencies that are going to be in big trouble. Bitcoin itself will not be in trouble. So I wanted to finish this by buying the $30 worth of Bitcoin that I said I was going to buy yesterday. I have about $389 in here. So we're going to go. It looks like I can actually get a little better price than I was trying to do it at yesterday. We're going to click confirm. And there is another $300, $400 worth of Bitcoin that's about to be sent into cold storage that will never see the light of day again. So I encourage all of you, if you understand Bitcoin, if you've done your research, if you're as bullish on Bitcoin as I am, to use these dips as an opportunity to profit from the stupidity of leveraged long traders and use this volatility and these sort of dips to increase your own private holdings of Bitcoin. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.